Finance Currency here, source code speaking. Before I say anything else, I need you to do something for me. Drop a comment right now. Tell me what time it is where you are watching this video. Tell me which country, which city you are sitting in right now. I want to know who is watching this. I want to know where my audience is, because what I am about to show you in the next 20 minutes is going to change how you understand what just happened in the silver market. And if you are new here, hit that subscribe button right now. This channel breaks down what is actually happening in metals, not what the headlines want you to believe. We go deep, we go real, and we use data, not hype. Now let me tell you what just happened. Silver crashed $10 in 48 hours. Let me say that again so it sits with you properly. $10, 48 hours, an 11% move on paper, from $86.80 down to $77 even in 2 days. And while that was happening, while the paper market was getting absolutely destroyed, COMEX just reported that 50 million ounces of physical silver walked out the door in 30 days. 50 million ounces, a 12% reduction in total inventory in one single month. Now, I want you to hold those two facts in your mind at the same time. The paper price crashed 11%. The physical inventory drained 12%. If you think those two things are moving in the same direction for the same reason, you are not paying attention. And by the end of this video, you are going to understand exactly why those two numbers tell completely opposite stories. But first, let me set the environment, because context is everything. Right now, there is genuine uncertainty in global markets. War is escalating in multiple regions. Oil is swinging 5% in a single session on headlines that get denied 30 minutes later. The dollar is testing major technical levels. And in the middle of all of that chaos, silver just experienced one of its most violent two-day moves in recent memory. Nobody knows how any of this resolves. That is the truth. Anyone telling you they know exactly what happens next is not doing analysis. They are selling you something. That uncertainty is the environment. And in that environment, if you are trading with leverage and you do not have a clear plan, if you do not have a defined edge, if you do not know exactly where you are getting out in both directions, that is not trading. That is gambling. I need to be direct about this because the environment demands it. Psychology matters more right now than any setup, any chart pattern, any technical indicator. Your mindset is going to determine whether you survive this volatility or whether you become a casualty of it. There are two types of people watching this video right now. The first type is the active trader. If that is you, you need to know your setup, you need to know your edge, you need to know exactly where you are entering, exactly where you are exiting, and exactly how much you are willing to lose if you are wrong. If you do not have those answers before you place a trade, you should not be placing the trade. The second type is the long-term stacker. The person who is accumulating physical metal for a thesis that plays out over months, over years, not minutes. If that is you, I need you to hear this clearly. Watching every 5-minute candle in this environment is not going to help you. It is going to hurt you. It is going to shake you out of a position that you took for long-term reasons using short-term emotions. Your time frame is months. Act like it. The data is what matters. The inventory numbers, the delivery notices, the leverage ratios, the premiums, that is what moves the physical market, not a $2 paper swing at the New York Open. Now, let me tell you exactly what happened in the last 48 hours because the timeline matters. Silver was trading at $86.80. The market looked stable. Open interest was relatively balanced. And then it started. Within hours, aggressive selling hit the paper market, not physical selling, paper selling, contracts being dumped, stops being triggered, algorithms kicking in. The price started falling and it did not stop. 85, 83, 81, 79, and then it hit $77 even at the low, a $10 crash, 11% in 48 hours. Now here is what most people do not understand about how this works. The paper market and the physical market are two different things. They are connected, but they are not the same. The paper market trades contracts, promises, obligations. The physical market trades actual metal, ounces you can hold in your hand. When you see a $10 crash on the paper market, that does not mean physical silver became worthless. It means contracts were being sold aggressively enough to move the price. And while that was happening on paper, the physical market was telling a completely different story. Let me give you the COMEX numbers, because this is where reality meets narrative. Total COMEX silver inventory right now sits at 355,173,000 ounces. That is a new one-year low, the lowest inventory level in 12 months. 30 days ago, that number was over 400 million ounces. 50 million ounces have been drained from COMEX vaults in a single month. On Monday alone, 2,391,000 ounces walked out the door. And here is the part that should make you pay attention. That metal left through 3 separate vault custodians simultaneously. 3 different vaults, all reporting outflows on the same day. That is not random. That is coordinated demand for physical metal. Now, I want you to hold that thought because we are going to go much deeper into the inventory data in the next part of this video. I am going to show you the leverage ratios, the delivery notices, and why the registered silver number is the one that actually matters. But before we go there, I need you to understand something about how this market works. The paper price can crash while physical demand increases. Those two things can happen at the same time. And when they do, when the paper market is telling one story and the physical market is telling the opposite story, that divergence is the signal. That is what you should be watching, not the headline, not the price, the divergence. And right now, that divergence is screaming. Stay with me. This is going to get deep. Let us get into the data. Because numbers do not lie, and the numbers right now are telling a story that most people are not hearing. I already told you the headline. 50 million ounces drained from COMEX in 30 days, but that number by itself does not tell you everything you need to know. Let me break down what is actually happening inside the COMEX vault system. First, you need to understand the difference between total inventory and registered inventory. Total inventory is all the silver sitting in COMEX vaults. Some of it is available for delivery against futures contracts. Some of it is not. It is just being stored there. Registered inventory is the silver that is specifically earmarked and available for delivery. This is the metal that can actually be taken off the exchange when someone stands for delivery on their contract. Right now, total COMEX silver inventory sits at 355 million ounces. That is the one-year low I mentioned. But registered silver, that number is 87,985,000 ounces. Less than 88 million ounces of silver is actually available for delivery against open contracts. Now let me give you the leverage context that changes how you read those numbers. The total inventory leverage ratio right now sits at 1.62. That means for every ounce of total silver in COMEX vaults, there are 1.62 ounces of contractual claims on top of it. That is elevated but not extreme. But here is where it gets interesting. The registered leverage ratio, the ratio that measures claims against silver actually available for delivery, is 6.55 to 1. Let me make sure you understand what that means. For every single ounce of registered silver that exists in COMEX vaults, there are 6.5 ounces of contractual claims sitting on top of it. 6.5 contracts for every 1 ounce of deliverable metal. When people tell you the physical market is fine, when they say there is plenty of silver, when they say the inventory levels are healthy, ask them to explain a 6.55 to 1 registered leverage ratio at a new one-year inventory low. Ask them how that math works, because the math does not work. Not if everyone decides they want their metal at the same time. Now let me show you what is happening in the delivery process, because this is where the stress shows up. The March contract is in its delivery window right now, and the open interest in that contract has collapsed. We are talking about 1,500 to 1,800 contracts remaining. That translates to roughly 7 to 9 million ounces. The CME has shaken out almost everyone from that contract. The rollout happened under pressure. And there were reported technical difficulties during the process, screens freezing, delays in execution, the kinds of things that happen when the system is under stress. The people who are still standing for March delivery, they are not rolling quietly into the next month. They are staying. They want their metal. Meanwhile, the April contract is starting to build. Open interest is rising. Around 1,000 to 1,200 contracts so far. Roughly 5 to 6 million ounces. That buildup is something to watch, because as the April delivery window approaches, we will see whether this pattern of standing for delivery continues. Now let me give you the delivery notice numbers, because this is where you see who is actually taking metal off the exchange. On Monday alone, 241 delivery notices were issued. 241 contracts converted from paper promises to physical metal demands. For the month of March, total deliveries have climbed to 587 contracts. That translates to 25,435,000 ounces of physical silver being demanded through the formal COMEX delivery mechanism. 25 million ounces in one delivery month. And here's the part that should really make you think. The entities stopping these contracts, the ones taking delivery, are not retail stackers buying coins. These are large institutions going through the formal process to take physical metal off the exchange. Major banks are among the biggest stoppers. 71 contracts stopped by one major institution, 38 by another, 37 by a third. These are the largest financial institutions in the world, and they are taking physical silver through the delivery mechanism. Why? That is the question you should be asking. Why are major financial institutions taking physical delivery of silver through COMEX at the same time that paper prices are crashing? If silver was worthless, if the crash was reflecting real fundamentals, Why would institutions be standing in line to take metal? They would not. The fact that they are taking delivery tells you everything you need to know about the divergence between paper and physical. Now let me add another layer to this. The lease rate signal. In a normal, healthy silver market, the 1-month silver lease rate should round to 0. Leasing silver should be essentially free because there is plenty of it available. Right now, that is not happening. The 1-month lease rate is elevated. The 1-year swap rate is distorted in the wrong direction. We are seeing negative territory pricing, which indicates backwardation risk. What does that mean in plain language? Physical silver is more expensive to borrow because there is less of it accessible. The market is paying a premium to get access to physical metal, even while the paper price is crashing. That is the divergence. Paper price says silver is falling. Lease rates say physical silver is getting harder to find. One of those signals is lying to you, and I know which one I believe. Here's another data point that should make you pause. Since February 9th, roughly 15 million ounces of physical silver were sold by retail investors. People panic sold. They saw the price dropping, and they sold their metal. In a normal market, that selling pressure should have eased the tightness. 15 million ounces coming back into the market should have relieved some stress. It did not move the stress indicators at all. The lease rates stayed elevated. The inventory drain continued. The delivery notices kept coming. 15 million ounces of retail selling had zero measurable impact on the physical supply stress. That tells you how deep this demand goes. The metal is being absorbed as fast as it comes available. Now let me show you what is happening outside the United States, because the Western COMEX data is only half the story. If you are only watching COMEX, you are only seeing half the picture. The other half is happening in Shanghai. And what is happening there right now is something you need to understand. The Shanghai Gold Exchange, the SGE, and the Shanghai Futures Exchange, the SHFE, are the two primary metals exchanges in China. They represent how the world's largest physical buyer of precious metals is actually transacting. And the data just updated. Let me tell you what happened. For several days, the SGE inventory lines were completely absent from the data feeds. No updates, no numbers, just blank lines where the inventory should be. That by itself is unusual. When data goes dark, you should pay attention to why. When those lines finally came back, when the SGE finally updated its silver inventory numbers, here is what they showed. 13.2 tons drained from SGE vaults. 13 tons of physical silver leaving Shanghai in a single reporting window. On the SHFE side, the Shanghai Futures Exchange reported 47,000 ounces withdrawn on Wednesday alone. Total SHFE silver now sits at 9,478,000 ounces. Total SGE silver sits at 14,388,000 ounces. Combined, that is 26 metric tons out of Shanghai in a single reporting period. 26 tons. While the Western paper market was crashing silver 11%, Shanghai was pulling 26 tons of physical metal out of vaults. Now, here's where the story gets really interesting. The Shanghai premium. In a perfect world, silver would trade at the same price everywhere. London, New York, Shanghai. The price would be the price. But we do not live in a perfect world. We live in a world where physical metal commands different prices in different markets based on actual supply and demand. Right now, Western spot silver is trading around $84. Shanghai spot silver is trading at $97. That is a $13 premium. Let me say that again so it registers. If you want to buy physical silver in Shanghai right now, you have to pay $13 more per ounce than the Western paper price. That gap is not normal. That gap is not supposed to exist. And that gap did not close even after the 11% Western paper crash. Think about what that means. The paper market crashed, silver dropped from 86 to 77, an 11% move, and the Shanghai premium stayed intact. Chinese buyers were still paying $97 when Western contracts were trading at 77. Why? Because the physical market does not care what the paper price says. Physical buyers care about availability. They care about whether they can actually get the metal. And right now, getting physical metal in Shanghai requires paying a $13 premium over Western spot. That premium answers the same question from the opposite direction. The Western paper price is not where real buyers are transacting. Real buyers, the people who actually want physical silver, are paying $97 in Shanghai. They are taking delivery through COMEX at 84. They are absorbing every ounce that comes available. The paper price is a reflection of contract trading. The premium is a reflection of physical reality. And right now, those two things are telling opposite stories. Now, let me add some context about why this divergence matters so much. Silver is not just a precious metal. It is an industrial metal. It is used in solar panels, electronics, medical equipment, military applications. The demand for physical silver is structural. It is not going away. China is the world's largest manufacturer. They need silver for production, and they are paying a $13 premium to secure that supply. India is the world's second largest silver buyer. They are importing record amounts, even at these elevated prices. The physical demand story has not changed. The only thing that changed is the paper price, and paper prices can be moved. Let me show you how. In the futures market, you do not need to own silver to sell it. You can sell contracts that represent silver without having the physical metal. This is called short selling. When large amounts of contracts get sold in a short period of time, the price drops. This triggers stop losses from other traders. Those stop losses trigger more selling. The price drops further. Algorithms detect the momentum and add to the selling. Within minutes, you can move the price significantly without a single ounce of physical silver changing hands. That is what happened in this crash. The paper market moved, contracts were sold, prices dropped, stops were triggered, but the physical market did not change. The inventory kept draining. The deliveries kept coming. The Shanghai premium stayed intact. The paper move was real in the sense that prices actually fell, but it was not reflective of physical supply and demand. It was a paper event that created a physical opportunity. Now, I am not telling you what to do with that information. I am not telling you to buy or sell. That decision is yours. What I am telling you is to understand the difference between paper and physical. Understand that the price you see on a screen is not necessarily the price where physical metal transacts. Understand that when paper and physical diverge, one of them is wrong. And historically, when that divergence gets wide enough, physical wins. The paper price eventually has to reconcile with physical reality. It always has. It always will. The question is not if, the question is when. And while you wait for that reconciliation, while you watch the paper price bounce around on news and rumors and algorithmic trading, the physical inventory keeps draining. 50 million ounces in 30 days. 26 tons out of Shanghai in one reporting window. 6.55 to 1 registered leverage ratio. The clock is ticking. Now, let us talk about what is actually moving markets right now, because if you do not understand the psychology and the structure, you are going to get played. There's a book called Trading in the Zone. The central point of that book is simple but powerful. Traders do not fail because their thesis is wrong. They fail because they cannot handle uncertainty. Right now, uncertainty is the entire market. War headlines, fake news, oil swinging 5% on rumors that get denied 30 minutes later, dollar testing major levels, metals crashing and bouncing in the same session. This is not a normal environment. This is chaos. And in chaos, psychology determines survival. Let me give you a specific example from this week. A negotiation rumor surfaced about the conflict in the Middle East. Oil immediately dropped 4.5%. Traders saw the headline and sold. Algorithms detected the momentum and added to the selling. Within minutes, the move was significant. Then within 30 minutes, officials publicly denied the rumor. They said there were no negotiations. The headline was false. Oil recovered every single dollar it had lost. The entire move reversed in the same session. Now, I want you to think about this carefully. Someone planted that rumor. Someone benefited from that down move. In the 30 minutes between the headline and the denial, positions were opened and closed. Money changed hands. Who had short positions open when that rumor dropped? Who covered those shorts at the bottom and rode the recovery back up? This is not conspiracy. This is market structure. This is how large players move markets. They create narratives. They trigger algorithms. They shake out weak hands. And they accumulate or distribute while everyone else is panicking. The same dynamics apply to silver. When you see a $10 crash in 48 hours, you should ask yourself, who is on the other side of that trade? Who is buying what panic sellers are dumping? Who is taking delivery while retail is capitulating? The data already told you the answer. Major institutions are stopping delivery contracts. Large players are pulling metal out of COMEX. The Shanghai premium is holding steady. Someone is buying what you are selling. And they are not paying $84 in Shanghai. They are paying $97. Apply the same skepticism to silver that you would apply to that oil rumor. When the paper price crashes on heavy volume, ask who benefits from the down move. When stop losses get triggered and retail positions get liquidated, ask who is accumulating at those lower prices. When the inventory keeps draining while the price keeps falling, ask which signal is real and which one is manufactured. The market is not random, it is structured. And that structure favors participants who understand it. Now let me talk about how you should navigate this environment. Because knowing the structure is only half the battle. The other half is executing with discipline. First, know your time frame. If you are a trader, your time frame might be hours or days. You are trying to capture moves. You need to be nimble. If you are a stacker, your time frame is months or years. You are accumulating a position for a long-term thesis. You should not be reacting to every candle. The mistake most people make is mixing time frames. They take a long-term position but manage it with short-term emotions. They bought silver because they believe in the thesis, but they sell it because the price dropped $10. That is not investing. That is emotional trading without a plan. If your thesis is that silver will hit all-time highs before year-end, a $10 drop does not change that thesis. The fundamentals have not changed. The inventory is still draining. The demand is still strong. The leverage ratio is still elevated. Nothing about the long-term picture changed in 48 hours. What changed was the paper price. And paper prices are manipulated in the short term. Everyone knows this. Everyone agrees on this. So why would you let a short-term paper move shake you out of a long-term physical position? That is the psychology question you need to answer for yourself. Second, know your exit before you enter. Every position should have a defined exit in both directions. If you are right, where do you take profits? If you are wrong, where do you cut losses? If you cannot answer those questions before you enter a position, you should not enter the position. This is not negotiable. This is survival. In this environment, one fake headline can move markets 10% in either direction. If you are trading with leverage and you do not have a defined exit, you can lose everything before you have time to react. I have seen it happen. I have watched accounts blow up in minutes because someone was over-leveraged and did not have a stop. Do not let that be you. Third, separate the signal from the noise. The signal is the data, inventory levels, delivery notices, lease rates, premium. These are the numbers that tell you what is actually happening in the physical market. The noise is the price action, the hourly candles, the intraday swings, the headlines that move markets for 30 minutes and then reverse. Focus on the signal. Filter the noise. If you spend your day watching 5-minute candles while the inventory drains 50 million ounces, you are focused on the wrong thing. The data matters. The price is just the price. Fourth, understand that you are fighting against an asymmetric opponent. Large institutions have more information than you. They have faster execution. They have deeper pockets. They can move markets in ways you cannot. You do not beat them by trying to outtrade them. You beat them by having a time frame they cannot wait out. They need quarterly returns. You do not. They need to manage short-term volatility for their clients. You do not. Your edge as a small participant is patience. It is the ability to hold a position for months or years while institutions are forced to trade around short-term noise. Use that edge. Do not give it away by panic selling at the bottom. Let me tell you exactly what to watch from here, because information without action is just entertainment. And this channel is not about entertainment. It is about giving you the tools to make informed decisions. First, watch the DXY. The dollar index just tested a major technical level. The January 15th high, it surged above it, then closed back below it. In technical terms, that is called a swing failure pattern. It is a failed breakout, and that failure is part of why metals held the floor this week. But that does not mean the dollar is done. Here's what I want you to watch. If the DXY starts climbing again and makes a confirmed daily close back above that January 15th level, I would be reading that as additional near-term pressure coming for metals. A stronger dollar typically means lower metal prices in the short term. That is just the correlation. I am not telling you what to do. I am not calling a direction. I am telling you to watch that level because it matters. If the dollar fails again at that resistance, metals likely stabilize or rally. If the dollar breaks through convincingly, expect more downside pressure on silver in the short term. Watch it. Do not trade blindly around it, but watch it. Second, watch the Shanghai premium. I told you the premium right now is $13. Shanghai paying $97 while the West trades at $84. That premium is your real-time indicator of physical demand. If the premium narrows sharply, it means physical demand in China is easing. The urgency is fading. Buyers are stepping back. If the premium holds steady or widens, it means the paper price in the West is not where real buyers are transacting. The physical demand is still there, still strong, still pulling metal out of the system. Right now, the premium is holding. That tells you physical demand has not flinched despite the paper crash. Watch that number. It updates regularly, and it tells you more about real demand than any price chart. Third, watch oil. Energy is the leading indicator right now. Everything else follows it. Oil hit $78 as conflict escalated. It dropped on announcements about naval escorts and trade insurance. Then it recovered. The market rejected that intervention move. It is saying the supply risk is structural, not logistical. You cannot solve an Iranian drone campaign with a press release. Here is the level to watch. If oil reclaims and holds 78, the conflict escalation framework enters a new phase. Higher oil means more inflation pressure, more uncertainty, and typically more demand for hard assets. If oil breaks down below 70, it suggests the market is pricing in de-escalation. That might ease some of the safe haven bid for metals. Watch oil, it leads. Fourth, watch the COMEX inventory and delivery data. I gave you all the numbers in this video. 355 million total ounces, 87 million registered, 6.55 leverage ratio, 50 million ounces drained in 30 days. Those numbers update regularly. The drain has been consistent. The trend is clear. Watch for any acceleration in the drain. Watch for any increase in delivery notices. Watch for any widening in the leverage ratio. If the drain continues at this pace, we are talking about structural supply issues within months. The math does not lie. Fifth, watch yourself. This might be the most important thing I say in this entire video. Your psychology is going to determine whether you make it through this volatility or whether you become a casualty. Are you sleeping well? Are you checking prices every 5 minutes? Are you anxious, stressed, unable to focus on anything else? If yes, you are probably overexposed. You probably have more risk on than you can handle emotionally. There is no shame in reducing position size. There is no shame in taking some chips off the table. There is no shame in admitting that the volatility is too much. What is shameful is blowing up an account because your ego would not let you admit you were over-leveraged. Size your position so you can think clearly. If you cannot think clearly, you cannot make good decisions. And if you cannot make good decisions, the market will take your money. It is that simple. Now, let me close with this. I gave you a lot of data in this video, a lot of numbers, a lot of context. The paper market crashed $10. The physical market drained 50 million ounces. The Shanghai premium held at $13. The leverage ratio hit 6.55. Major institutions took delivery. The lease rate stayed elevated. Both sides of the picture are on the table. The bearish case is real. The paper price broke down. Technical levels failed. The dollar is testing resistance. If it breaks higher, more downside could come. The bullish case is also real. The physical market is tight. The inventory is draining. The premium is wide. Institutions are taking metal. I am not here to tell you which side is right. I am here to give you the information so you can decide for yourself. What you do with this information is entirely your decision. Buy, sell, hold, do nothing. Those are all valid choices depending on your situation, your risk tolerance, your time frame. But whatever you do it with a plan. Do it with defined risk. Do it with clear exits. Do not gamble. Trade if you have an edge. Stack if you have a thesis, but do not gamble. Now, before I go, I asked you at the beginning to drop a comment. Tell me what time it is where you are watching this. Tell me where you are from. I want to know who is watching this channel. I want to know who finds this valuable. And if you found this valuable, if this gave you clarity, if this helped you understand what is actually happening, hit that subscribe button. Join this community. We go deep here. We use data. We cut through the noise. Finance currency is not about hype. It is about logic. It is about understanding the market structure so you do not get played. Subscribe. Turn on notifications. And I will see you in the next one. Invest with logic, not hype. Finance currency out.